Yo, YouTube, you could be anywhere in this world, but you're right here with us. So thank you for joining us. I'm Chris. This is Dave. And we got a goodie for you today. Right, Dave?
Yes, sir. Yes, sir. How's it going, peeps? Hope all is well. Chris and David and Chris, head traders at Traders Creed. So as Chris mentioned, we do have a little something of, we think of a good video in our personal opinion. So we know we've been talking about discussing a lot of the criteria and setups and things that we look for that make up the foundations of our method that keep us consistently profitable throughout the weeks, throughout the months, and throughout the years. So that's something that's been long on our list to get through to you guys. And today we decided we're going to go ahead and do it. And for kicks as well, we are going to apply those principles and all that stuff that we look for on the euro yen, as we feel that we spotted a really good opportunity to take to the downside on the euro yen. Mind you, our principles apply to the upside as well as the downside. We are not just buyers of the market or short sellers. We're two-way traders, man. Our principles apply equally, as well as on the upside as well as to the downside. So
Yep,
that's
we have
something.
the easy job, Dave. All we do is extract money from the market. We got it easy.
That's it, man. That's it. Mind you, guys, it has taken us years to get here. All of the complex and sophisticated elements and variables that we have learned and experienced in the financial markets have created the simplicity of our method. We don't just want to sound like we're these all-seeing beings. The markets are very ruthless and challenging and exceedingly difficult. But when you have process, when you have method, it helps eradicate a lot of the difficult challenges and obstacles that you will be faced with as a professional trader. Because when you have process, guys, you just know what the fuck to look for, plain and simple. And once you know what to look for, it becomes second nature. And as I've mentioned in prior videos, as you become more skilled and experienced, you can literally look at a chart and within seconds know whether that is a good chart to be identifying for an opportunity or move on to the next thing. So as we said, we spotted something good on the euro yen, and we will be discussing a lot of our criteria. So good morning, good afternoon, good evening, wherever the hell you are on our tiny blue planet. We wish you well. Mind you, this is never financial advice. This is all for educational purposes only. So always do your due diligence before you listen to two guys on the internet. But we always put our money where our mouth is. That way, you know, we're more than qualified to talk about the things that we're talking about. But anyways, let's go ahead and talk about the foundations of our method and who we are as traders. So Chris and I are very short to medium term discretionary, quantitative, and technical currency traders. We specialize in order flow analysis, liquidity manipulation, i.e. stop hunting as it's commonly referred to, and any and all of the covert tactics that these big institutions, big entities, smart money hedge funds are using to manipulate you, the retail trader, to take money away from you. Because if we're being honest, at the end of the day, that's what the markets are here to do. They're here to take money away from you. But the game is winnable. That's what we want to let you know. There is hope if you know what you're doing, and we are going to show you that it is possible and that you can do it. And hopefully today, after today's video, you guys begin to walk away with some fresh insights. As always, take what you like, discard what you don't. And we hope that you are able to extract some form of gems out of this video. So let's go ahead and get straight into it. When you become a trader, in order for you to have edge is going to stem from you knowing what you're doing. And you knowing what you're doing is going to come from experience, time in the market, screen time, trial and error, making mistakes, making money, losing money, etc., etc. Over time, if you are aware as a trader, if you are not the person that is doing the same dumb shit over and over, beating your head against a brick wall, expecting a different result, you are not going to move forward. You are not going to facilitate progress. But if you are hyper aware of every decision that you make in the financial markets, of all the trades that you take, you do a lot of back testing, you'll eventually start to nut out a lot of recurring themes, narratives. You'll begin to see specific things in the markets that you can take advantage of, that you can exploit for money. Now, Chris and I, we are never too keen on calling our setups patterns. The problem with the issue that I have with that word is that it makes traders believe that there is this simple cookie cutter, black and white, 1, 2, 3 step approach to the financial markets. That's why I don't like to use the word patterns. Chris and I, we prefer to use the word context and narratives, scenarios, probabilistic outcomes, because really the markets are dynamic. You can't simplify it into patterns, because if there were such thing as consistent patterns in the markets, everybody would be rich. Yes, there are reoccurring themes that happen in the financial markets, but it's never really the same. And I think Chris and I, we can speak from personal experience out of all the years that we have under our belt, that all of our setups, they never look the same. They are similar in certain variations, but they never look the same. So that's first and foremost. You need method, you need process. This is going to come in time. But once you begin to have process, then you need to have a criteria checklist. You need to have a specific set of rules or parameters that are going to guide your decision making. Yes, Chris and I, we're discretionary traders. We're not, technical or quantitative. We see this, and that. If we don't see all our variables, we don't execute a trade. No, the markets are dynamic. It's unrealistic to think that you are going to see all of your checklist in play in one chart. You just got to roll with the punches. The more things that you can check off in terms of your filtering process, the better outcome of success you are going to have as a trader. But once again, it is unrealistic to think that you are going to be spotting and identifying all these variables and elements before you execute a trade. I know that's that's very difficult for a lot of people to come into grips with. The markets are very ambiguous, and it's kind of just you roll with the punches kind of thing. So
you have to be willing to adapt, because if not, Dave, it's literally leaves you behind.
Exactly. So you have to have the courage to execute in the face of the unknown. The markets are a probabilistic domain. So the thing is that you are treading in the unknown, and you have to embrace and accept and make peace at the fact that at the end of the day, you're making decisions without accounting for 100% of data. That's the thing. And you have to make peace with that. Otherwise, you are not going to succeed as a trader. So that's the first thing. That's very, very important. You need method and you need process. And then you need things that are going to help make your decision-making process a lot easier. Now let's get to the good stuff. Let's talk about the things that Chris and I look for that help make our decision-making process a lot easier. And then we are going to cover the details of every single variable that we look for so it makes sense. We don't just have a 1, 2, 3 step process and not understand why it's there. As a trader, in order for you to have faith in your method, you need to understand why the fuck it makes money. If you don't understand why it makes money, you're not going to have faith to stick with it over the long term. So with that said, let's go ahead and talk about the 10 things that that make up the foundations of our method. So let me go ahead and get my text box here. First and foremost, we look for what we call a break of structure. And we'll break this down in a little bit after I write all of them down. So second thing, we look for directional impulsive moves. Third thing we look for is key levels. Did I spell that right? I don't think I did, man.
ELS, you got it.
There we go, man. Sorry about that. All right, fourth thing we look for is confirmed ranges. Fifth thing we look for are traps. 6, no follow through. 7, liquidity manipulation, or i.e. stop hunts. That's all it really is. Liquidity manipulation is just a fancy word for saying stop hunt. Eighth thing we look for are targets. And exits. 9, accumulation zones. And 10, which is probably the most sophisticated part of becoming a trader, is fundamental and sentiment analysis. This little framework here has kept Chris and I making money time and time again. That's not to say that we're always going to be winning. No trader wins 100% of the time. If they are, they're either A, bullshitting you, or if, they are winning 100% of the time, they're probably aliens. They're not fucking human. I'll tell you that much, man. Because no human being is... The problem with being a trader is that we are burdened with our emotions. Our emotions make us very irrational. It distorts our perception of reality. And what it does is that under pressure, we tend to make stupid decisions. So even though Chris and I have a consistently profitable method, him and I are humble enough to tell you we fuck up sometimes. That's just part of the game, bro. Sometimes we'll doubt ourselves. Sometimes we'll exit a little early. We'll hold on longer than we need to. But overall, we are generally profitable and consistent because of these 10 steps that we have in our process. These make up the foundations of everything that we do. And as long as we adhere to these things, we will make money, plain and simple. And we show a lot of our guys that we are consistently profitable over and over again. So this little framework has helped a lot of our students as well reach the ranks of consistency and professional traders. So let's go ahead and break down each one in thorough detail and why we look for it and why it's part of our criteria checklist. So break of structure. What makes the break of structure for us very, very important, or why we look for it, these generally happen at the extreme points. They are generally a high or low of the day, week, or month. But on lower time frames, such as the hourly or maybe even lower than that, you'll generally find when the market puts a high or low, what we call peak formations, it will look a specific way and the market will literally, it just won't budge. It'll put in that high or that low and then it'll immediately reverse in the other way. It's unrealistic to think that you're going to be catching these moves, tops and bottoms, very consistently. It doesn't happen. Yes, Chris and I and a lot of our students, sometimes we're a little bit early and we do get lucky. We pinch off the tops and bottoms of certain moves, but it doesn't happen frequently. It's very rare when it happens. It's like, unless we're on our game, we can anticipate it with a high degree of accuracy and precision. We're a little early, and therefore we're able to maximize very aggressive risk to reward profiles. But it's not important to time it. It's just important to identify it. So what does actually, let me go ahead and map out something real quick. Let me go ahead and map out a little quick scenario of what all this stuff generally looks like. Let's just say we get some form of structure like this, right? Okay, there we are. I think this little template right here is just going to make things so much easier for all of us. Because then we'll be able to check all this stuff as we're going along with the video. And most importantly, we will give you a real-time example. We're not just going to cherry pick this fucking idea. We're actually going to give you a real-life example. So in the case, let's say we have a buy-week structure or a sell-week structure. Whenever we feel that a specific week is a time to be longing a specific currency, Chris and I, we will refer to that as a buy-week structure. Generally, you want to be longing when you see these criteria to the upside. When we have a sell week structure, it's because we've identified a break of structure at the highs. Maybe that might be the high of the day, the high of the week, high of the month, et cetera, et cetera. But bottom line, when you've identified whether that week is a buy week or a sell week, you just want to be playing along with that narrative. Buy week means long, buy the market up until further notice, and sell week means sell the market, short the market up until further notice. But in this example, we're going to break it down to the upside. So a break of structure is when you get a low put in. And you need some form of structure to work off of. You can't, this doesn't qualify as anything. For all we know, it could just be like a little bounce and then it'll continue down. But bottom line, you need some form of structure to have already elapsed before you can identify this. So usually what we've seen time and time again is that the market will put in a low, it puts in another low, it might breach that low, but there's this inefficiency in price where it's not really moving anywhere. It's just hovering at those lows, and all of a sudden it will spring up and reverse in the other direction. After that pullback, and you get a breach of that pullback and a retest, this is what we refer to the neckline. Sometimes it might even be a fucking head and shoulders, whatever. The point is that this point, this price level, this form of structure is of importance to us. So once we get that break, that pullback, now we're interested in the idea. Now we're interested in the trade. This is step one, break of structure. Because generally, this is a high statistical probability that when you get a break of structure, the market is likely to reverse and you can take opportunities in the opposite direction. This is what we also call a fake out. Sellers were enticed to take the market as that prior low was being breached, and all of a sudden they were trapped in their position, being forced to liquidate out of them. So that's all a break of structure is, man. It is just a strong indication at the highs or the lows that the market is likely to reverse, and you can play with that narrative. And it's usually a strong indicator that a high of the day, week, or month has been put in, etc., etc. Plain and simple. You don't need to complicate this shit. And mind you, it's not important to time it. It's just important to identify it. So you start going through. This is what we call the filtering process. As you begin to filter out your ideas and you're checking things off your list, now you're maximizing the probabilistic outcome of a trade. You're going to make it more successful. So now let's move into the second step, or criteria. We look for directional impulse moves. So a directional impulse move is typically when we get that break of structure, the market is confirming that it is moving in the opposite direction. And once again, we'll look at real-time examples and see if we can go ahead and spot them. But bottom line, why is directional impulse moves important? Well, if you know anything about the real space, you probably have done these mistakes. Chris and I, we can tell you from first-hand experience that we have made this mistake several times. Traders chase markets. It's called FOMO, fear of missing out and fear of losing money. But in the case of fear of missing out, when traders are honed in on real-time price action, what they'll generally do is when they see price move in a very volatile fashion or in one way or the other, their emotions start clicking. They become stimulated, and as a result of that, they're willing to risk capital, whether the decision is a logical or a rational one. They don't care. They're going to risk capital just to get in some action, just to not miss an opportunity to make money. This is very dangerous, though. You might get lucky here and there sometimes, but the problem with chasing moves, guys, is that if you're chasing a move, for example, in a buy week scenario, the whole point for you to make any money as a trader is you generally want to buy fucking low and you want to sell high. The problem with the retail space, the reason they're called retail traders is because they buy at retail prices. They don't buy low and sell high. They buy high, and then when the market pushes back, they sell low at a loss. So that's the problem. You want to make sure that when you see an impulsive move, you don't get stimulated with the rest of the retail space. Our job as professional traders is to take a step back, control ourselves, possess that immense self-control to just wait and look for opportunities in where traders are making all the mistakes. All the retail traders are making the same mistakes. You don't want to be part of that 90%. The whole point of our method is to outsmart the next guy and exploit his mistakes, exploit his pains. Now, I know that's not a very polite thing to say, but in any zero-sum game, there's got to be winners and there's got to be losers. You got to figure out what side you want to be playing on. So don't be making the same mistakes as the rest of the retail space. So a directional impulse move is just another variable that we look for that adds weight to our bias. We know with our break of structure, for example, the market was selling off, we get that break of structure. Now we're starting to get the idea, maybe we should start to look for long opportunities. That impulsive move as the market continues to move higher. Okay, now we know sellers were caught on the wrong side. They're probably flipping their positions. Fresh buyers are chasing the move. That's why we're getting that parabolic move. You don't chase. Once again, just let enough price action and market structure unfold. for you to make logical decisions. So that's just another variable that we look for. Next thing is we start to deploy key levels. We start to ask ourselves, okay, what price points are going to be the most attractive for us if an opportunity does present itself for us to interact and transact to get in at the best available price possible to maximize reward relative to the risk that we take. This is a very difficult step to accomplish.
I was just about to say that, Dave. I was about to say that. I think this one is something that you really have to touch up on, because when I first met you, Dave, you changed the way I see key levels. Do you remember when I used to play my key levels? You'd be like, move it up just a bit more, and then like little things like that changed the way I trade. I started trading.
Oh man, that's awesome, bro. And it's just and can you speak on firsthand experience, Chris, how much those little adjustments made all the difference in your trading?
Dave, it's the total difference, because if you think about it, if let's say you place your stop loss maybe a little too tight and you're not looking at a real key level where it's a lot more, it's a lot more safer to put your stop loss there, you get stopped out and see it go your way. It could also be that you're entering way too early as well. If you're not putting your key levels at a confirmed key level where there's multiple touches, you tend to want to look at the bigger time frames to have a better idea. But yeah, I think this is one of the most important things, because you'd be surprised how not having a key level will make a complete difference in your trading career.
Exactly, man. I'm
Uh,
so glad that you banged about that point because we focus on four core tenets in our Discord, and that's effectiveness, efficiency, accuracy, and precision. Let me repeat that one more time: effectiveness, efficiency, accuracy, and precision. When you are deploying your key levels at accurate and precise points, that makes a world of a difference. Traders don't even know what the fuck a key level is or why round numbers are significant. They just see like, oh, round numbers are psychological levels, but they don't know why. They just go with the flow or what they hear or what they learn. But what has made our method successful is that Chris and I have literally delved as deep as we can go into that fucking void, that rabbit hole, and we began to understand things at a very sophisticated level. So if you look on the right side of the chart here on the euro yen, you're going to see a bunch of round numbers: 127, 126, 125, 124, 123. These are all key levels. Now, here's the thing. You don't have to mark them all up. You only have to mark the ones that are relevant to you. Why are they important? Why are they significant levels? Well, this is where the majority of big institutions and retail traders are transacting. This is where they are getting the bulk of their orders deployed. However, nothing works in a perfect world in trading. Just because price approaches a key level doesn't mean it's immediately going to deflect or bounce off that level. It's just a price point where orders are going to be deployed, fulfilled, and any breaches outside of those levels are what we call average price fills. Orders are getting fulfilled because if you're a big institution deploying about maybe a $50 billion to $100 billion order, you're not always going to get the best fills. So this is where the funny games begin to happen, is that they understand in order for them to deploy their sizable chunks of orders, which we call iceberg orders, they have to do it around a specific price point, and it's going to breach the level. It's going to hover around that level, and you're just going to see a bunch of choppy price action around these levels. And all the while this is happening, retail traders are getting manipulated.
yep. I think it's important too, Dave, to like not overthink these levels on the reasoning on why these levels are important. It's like that's not our job to really know why these levels are important. It's just a level that these hedge funds love to transact at. What's the reason they're transacting there? Who cares?
Yeah, who knows? Because you are not going to have access to that information. When, let's say, price right now is failing at the 126, we don't know why big institutions are seeing that the euro yen is no longer of value at that price point. You will not have access to that information. The point as technicians, as technical analysts, is just to identify these clues and these footprints and just work with that. You are not going to have access to this information unless you're an inside trader or you work for a big hedge fund. But if you are just a retail trader like Chris and I, making money from their laptop, you don't need to understand why they're important. You just need to understand that they are important and to map it out, to reference it. So key levels, they are at round numbers and at the midpoint of these round numbers, or the 50s. So what Chris and I, we like to do is that we like to deploy a horizontal line. You can go ahead and get that on your toolbox over there. And we deploy it at the price levels that are the most relevant to us in the price action that is currently unfolding. As I said, you guys don't need to fucking map out every goddamn level. Just map out the ones that are going to be important in the time frame that you want to make money. So for example, we see one at the 126. Make sure you get those coordinates right too. Be precise, man. Think like a damn sniper. This is how you make money. So take it very seriously. Take your work very, very seriously. Where else do we see a key level? We see it at the 125. There you go, 125. Sure, you can make the case like, oh, there's one at the 127, but price hasn't really breached outside that level. Price isn't really at that price level, so we don't have to map it out. Keep your charts nice and clean. You don't need to have a clutter of a bunch of shit on your chart. Just keep it nice and clean. Focus on the things that are relevant for you right now in this moment for you to make an accurate decision. Also, you zoom in to get the 50s. There you go, 125.50. So what Chris and I like to do is we like to change the lining on this one just so we know that it's a 50. We like those dashed lines, man. And then we'll zoom in a little bit more if we have to. All right, hold on. I don't know what the hell is going on. There we go. There we go. All right, let's just zoom out a little bit more. Sorry, guys, my internet's been crappy, as I've mentioned prior. Here's 126,500. Price has interacted at that price level, so it's important to reference because maybe it might come back there. You don't know that. But there we go. Your key levels are mapped out. So around these price points are where you want to be making decisions. These are where you're going to make the best accurate decisions that are going to maximize your reward relative to the risk, and they're going to maximize the odds of success for your trade. So now that we got our key levels mapped out, now let's move on to the next step. I really don't know what the hell is going on. Sorry about this, guys. There we go. We're having some technical difficulties, but we'll just go with the punches. So fourth step, confirmed range. So now let's go ahead and apply our fourth step to this little example here. So once you get your breakup structure, directional impulse move, you've deployed your key levels, you know where you might want to be transacting if price approaches one of those levels at some point in the future. The reason key levels are very difficult, just to bang about that point earlier, is that you have to have immense patience as a trader. Patience is the number one thing. If you don't have it, this is what's killing your success as a trader. Because I understand as a retail trader, you are under the impression that it's like the Wild Wild West. You need to be in a trade every minute of every day. It's not the case, man. You need to be in a trade when you have all these variables in your favor, and that trade is not a 50-50 trade. A lot of our guys, Chris and I, we don't take fucking 50-50 trades. That's called gambling. If you want to gamble, go to the casino, because trust me, that's a lot more fun than this shit right here. This is not fun. It's not supposed to be fun. But you can make money, once again, if you have your process. So now that we've identified the first three steps, now we need to map out what we call a confirmed range. So yeah, I really don't know what's going on. You see that, Chris? It's kind of like chopping out. Is it just me? Okay, give me 1 second, guys. We're going through some technical difficulties here. Okay. Let me just get it nice and centered. And once we do that, we're just not going to fucking move it. How about that? There we go. We're not moving this shit because I'm not dealing with it. All right. So now we need to have a confirmed range. Why are ranges important for us? Confirmed ranges at that. Well, if you guys study price behavior, the dynamics of price movements, things of that nature, they only do one of two things. They're going to move and then the moves are going to exhaust themselves, and then they will consolidate, range, accumulation zones, distribution zone, whatever the hell you want to call it. Every trader calls it a different thing. Just for the sake of this example, we're going to keep it short and simple. You guys will refer to this as consolidation ranges, or moments in where the market will exhaust itself. This is important for us because this is where we know where we could start to get into the order flow analysis of our method. We know that once there's a range, accurate levels are being confirmed, traders are going to make decisions around this area. And we want to be able to outsmart the next guy for him to make a mistake. And once we can identify that they've made a mistake, that's our moment to act. So confirm range. How do we confirm a range? Pretty simple. As a move creates that impulsive move, it'll kind of just hover about within specific price points and won't really go anywhere. A minimum of 1 to 2 tests at the highs. That was very sloppy. So 1, 2 tests at resistance, 1, 2 tests at support. If you get those contact points, that range is good enough for us. The more, the merrier, but 1 to 2 is more than enough. Well, actually, you need 2 to obviously confirm it. But once you have 2 contact points at resistance and at support, that now we're interested, because now we know there's going to be a bunch of traders and level traders that are going to be waiting to transact around these price points. So once you have your confirmed range, this is where you are now getting closer to execute a trade. Now, in the case of a bullish week or a long opportunity, we also move into our next set, what we call traps. This is where a lot of the manipulation begins to happen, because mind you, big institutions, if they are moving the market in a specific direction as well, and they need to keep deploying orders, or if the fundamentals still stand, or there's reasons to keep buying up a market, they will manipulate a lot of traders within this stage of our method, within this cycle of the process. And the reason they do it is because it's very easy to do it. The reason they manipulate retail traders is because they're getting in at the best prices possible when there's a bunch of willing buying and selling and forced liquidation occurring outside of these extreme points or outside of the ranges. And generally, they're going to get the best fill possible, and they're going to avoid the cost of slippage. Slippage, when you're a retail trader, does not cost you a lot of money, but when you're deploying and transacting with hundreds of millions or billions of dollars, slippage adds up to a pretty size of money. It adds up to a sizable sum of money. In case you guys haven't noticed, every time you execute a trade, you are immediately in the red. Why is that? Because the price between the bid and ask spread, which we call the spread, is the commission that you're paying to your broker. And that is the form of slippage. So the minute you enter a trade, you will always be in the red, just by default. Now, imagine the bigger your contract sizes that you are transacting with, the bigger that slippage. So when you are trading with billions of dollars, yeah, you are gonna be in the red, quite a big sum of money, millions of dollars, like hundreds of thousands, if not millions of dollars, depending on the amount that you're trading with. So yeah, it ain't small cheese, man. And you need to be efficient and effective when you're deploying these orders, and that's going to happen at these ranges. So the next thing that we look for are traps. That's our 5th step. Traps are simply where level traders are getting involved. We know that they're buying up a market at a level of support, but price isn't seeing any significant follow through, which is the 6th step. So price will bounce off a level. You get a lot of level traders come in and they're like, dude, this is a perfect time to get long. They're starting to place their stop losses or stop orders at very predictable areas. They generally place them pretty tight, because if they're wrong, they want to be out quickly. And if they're right, they want to be able to have an aggressive risk to reward profile. That's everybody's intention in this business. You know, a lot of people, they'll settle for a 1-to-1, but if they can find a way to make a 1-to-3, 1-to-4, 1-to-8, they're going to do whatever they can in order to make that happen. And generally, the way retail traders go about that is by placing really tight stop losses. This is a problem if you're just transacting with everybody else, because now your moves become predictable, your behavior becomes predictable, and you become easy picking for the wolves or smart money hedge funds. So as this level of support begins to be interacted with several times, and there is no significant follow through in terms of price action to the other side of the range, because if you're a retail trader, where would you likely take profit? Say you're entering right here at this level of support. Where would you likely take profit? You would likely take it at the most obvious level of structure. That's going to be at that high there. But if price isn't following through, isn't moving at anywhere near those highs to any significant degree, there's a problem. This is the problem. And when you're in a trade, you lose objectivity. You throw rationality out the door rather than be like, price isn't going where I'm anticipating it's likely to go. Maybe I need to reassess my trade. No, traders, the retail space, what they do is like, the minute price starts moving in their favor, dopamine starts getting released, man. They start losing their shit. So they get excited, they're in the money, price pulls back, they believe in their idea so much, they are so biased and so honed in on the real-time price action that they fail to account for various other things that are going to help them make a better decision to the one that they've currently made. So if price isn't following through, rather than assess that, they'll instantly say, oh, dude, it's going to go my way. It's going to go my way. It pulls back to that level again. They start to add. New level traders start coming into the market, because if they miss that move the first time and they see price come back again, they're gonna take that as an opportunity to enter. And then we start getting a pool of liquidity build up underneath that range, or what we call a cluster of stop losses, continue to build up. And the more times that level is interacted with, the dangerous that becomes. I know there's a saying in the retail space that goes, oh, the more times a level is tested, the stronger it becomes. That is true to a certain extent. But big boys know that. They know how you think. They're using that against you. So the more liquidity that gets built up underneath this range, boom, this is where the manipulations begin to happen. So there are two types of participants around the form of this cycle of the manipulation phase. There are willing buying and sellers, and then there's forced liquidation. So here in this process of the manipulation cycle, you're getting willing buyers. They're willing to buy. They're making their own decision. And then as price breaches that level, that is what we call forced liquidation. They are getting stopped out of their orders by force, because they're not stopping themselves out. They're getting stopped out by force. But then as this part of the cycle begins, it's now attracting a new participant, sellers, willing sellers, because they're like, oh, you know what? The level was breached. We're getting a breakout retest. That prior low was breached. The market has to tank. It has to go down from here. So now you're getting willing sellers come into the markets, and then they're going to place their stop orders at obvious levels of structure around these price points, around those key little pivots. So all the while that is happening, these big institutions, knowing where they want to take the market, they're deploying their orders. So you get three types of core disciplines. You get level traders, you get breakout traders, and then you get retracement traders. If you really think about it, sure, there are several strategies out there, methods and things like that, but the foundations of those strategies are comprised of really three types of participants. That's level traders, breakout traders, and retracement traders. So all of this is attracting all of these types of traders. Level traders getting in at this level of support, breakout traders getting in at that breach of the lows, retracement traders getting in at that pullback, placing their stop orders at very obvious levels of structure, more breakout traders getting enticed after another breach of those lows. And then we know that all this pool of liquidity was absorbed by these big institutions. So when when this forced liquidation process happens, mind you, if you are a buyer in the market, in order for you to exit your position, you have to sell. If you want to sell, if you're selling your, for example, an investment or an asset or a trade, you have to buy back your position to exit. So if you buy something, it's because you believe it's going to go up. And when you sell it, it's because you believe there's no longer any value in holding it. You want to exit, and vice versa, et cetera, et cetera. So all the while, these this cluster of stop orders are hovering underneath this low. When these big institutions are deploying massive amounts of orders, they need an equal amount of opposing traders or volume to take the other side of their transaction. So if they want to buy, they need people to sell it to them. Because if you want to buy, somebody needs to sell it to you. So in this part of the cycle, when they're attracting all these willing sellers, they're willing to sell the asset at that particular price. They're now given the opportunity to buy and deploy maybe the last amounts of their orders. So, and once the manipulation is complete, and mind you, it can look in several variations. It can look like a little quick V-stop, little double swipe as we just illustrated there. Nice little head and shoulders. It could look like a double bottom. We don't know. The point is that Chris and I, we know when this level of support has been breached, we are now hyper-focused to want to transact. And once we see specific footprints underneath that level, and generally the footprints, they're pretty obvious, man. They look very, very wicky. I hate to use that word because I know it's not a real word, but the candlesticks look very, very wicky at those lows. That's signifying big institutions are buying up those price points. So once the manipulation cycle is complete, all the liquidity from sellers up at these highs are fuel to get this market to move in a very volatile fashion. So once the manipulation is complete, you will generally see our setups, boom, pop back inside that level and go straight to the moon in a very, very fast momentum. So yeah, that's it can be very, very profitable, and you can make money in a very short space of time if you are actually on the right side of that trade, because once the big institutions deploy their orders and they let it go to wherever it needs to go, it's going to move very, very quickly because, mind you, everybody was manipulated in this cycle. This is what we call the manipulation cycle. And in this cycle, it's going to consist of willing buyers and sellers and then forced liquidation. So hopefully that made any sense. I hope you guys kind of started to get an understanding of that. I understand that it can be very, very complex. It's going to take a lot of repetition and time in the markets to really understand what we just said. But that's really the name of the game. This is the nature of the business. This is why retail traders get manipulated. And this is why stop hunting is a real thing in the financial markets. So we've already discussed everything up to step 6. And we already pretty much covered 7, man. The liquidity manipulation, the stop hunt. Anything underneath that price point, once again, those stop hunts are going to look very, very different. They're never going to look the same. But once you've identified that stop hunt, or Chris and I, since we're very aggressive and we're not really scared of the risk, we will be taking trades as that price action is unfolding underneath those lows. If you guys are kind of a little bit gun shy or a little bit risk averse, you wait for the setup to complete, and you can wait for a break back inside the range or whatever works for you. We're giving you the principles. You guys just adapt it and apply it to your own liking into a way that makes sense to you and in a way that you're going to make money. So now let's move into the final steps. Number 8, targets and exits. This is pretty much the fun part. So once you've identified the stop hunt, once you've identified the setup, it's pretty straightforward for us. If we know this to be the setup for us, where big institutions basically manipulated all these traders, if this is the stop hunt play, generally price is unlikely to come back and take out the moves that it initially just put in. Why? Because why the fuck would big institutions stop themselves out? That doesn't make sense. Why would they deploy a bunch of massive buy orders if they didn't believe that price was going to continue to go up? Why would you do that? So generally, this is a solid indication for us to place a really tight stop order right underneath this low, right underneath the lows that were just put in. You guys need to figure that stuff out, man. There is no black and white approach to this. You can put it a couple pips away, like 15 to 25 pips. You can use an ATR to see how volatile a pair is. But generally, on really volatile pairs, you need to have a stop loss of 30 pips above. If it's a very, very slow or less volatile pair, you can generally get away with about 15 to 25 pips. But generally, Chris and I, we have some really tight stop loss. Sometimes they will be about 8 to 12 pips, because once that low is put in and we just believe that that is our setup, that is our move, the stop hunt is complete, our setup has reached completion, we know where to put our stop, and it's literally a couple ticks right underneath that low. And once we know where our exit is, because you always want to trade with the stop loss, you are never going to be 100% right. So you need to make sure you're protecting yourself in the event that you are wrong. Then we move into targets. So let me go ahead. Give me 1 second here. So now that we know where to put our stop, get that type of setup, you'll place it a couple ticks underneath that low. That's your stop loss. When price pulls back into the range, generally you'd like to target what we refer to the midpoint of the range. And that, you just kind of eye that thing, man. That's a very discretionary type of decision. There is no black and white type of approach to that. We just target the midpoint of the range. Anywhere inside of that range, we like to take our first target, and then our second target, we like to exit at the prior highs that it put in. That is the most obvious level of structure. And if you're getting in early, you will generally have this as your risk and all of this as your reward. And you can get away with some really aggressive risk to reward profiles. But generally, you just want to get out at the midpoint at your first target and your second target at the highs. If you truly believe that this move is likely to continue to the upside, which is generally the case, you wouldn't take profit at the midpoint. You would take it at the highs as your first target, and then you would look to take an extended target past the range. And at that point, that's where you're trading in murky waters, because that's where you have to start to make more discretionary decisions. You kind of have to eye things. Our method is simple. Have a midpoint, take it at the high structure or slightly above, and you're done. You're in and out. No problem. Don't stress yourself. But if you really want to hold the trade longer, because when we get to the last part of the steps, you might have fundamental reasons for that. You might have other reasons for that. Sure, you can do that, but just understand, the longer you hold the trade, the more you're eroding its statistical outcome of success, just so you know. But if you want to hold it, that by all means. Just when your first target is made, this is where we move on to the second part of our element, our method, is that when your first target is made and price has moved a significant distance outside of your initial entry, and you got in pretty early, you would move your stop loss to break even, just to eradicate risk. Get risk out of the table, lock in those gains, secure in those gains, because sometimes it might just hit the midpoint and then it'll just come back and tank. Or it might even come back for another stop hunt at that low move, or if not, it'll just come back and completely shit the bed. So many things could happen. That's why you really want to break even once your first target is made. But if it's a really volatile currency pair, literally this thing will just blast through the fucking highs. We've seen it time and time again, and Chris and I, we've had trades where we've entered we've entered one day, and in the next hour or two, both our targets have been made. And it's insane, man. It's insane to know that you just made somebody's monthly check in a very short space of time. So good stuff, man. Good stuff. But with that said, accumulation zones, which I don't think we're going to really cover into much depth. That's pretty much accumulation zones. They can tie in with the break of structure. They tie in with the breaks of structure. Reason being is because when price is putting in a new low, big institution, market makers, whatever the hell you want to call them, when they are accumulating at these lows or at specific price points, it's what we call an accumulation zone. and it will look pretty specific. A lot of our traders make some decent money off this setup. So accumulation zones is once again when price is putting in these lows, but it is not moving anywhere significant.
Looks like a box.
It literally looks like a box, man. Accumulation box, accumulation zone, and it's contained in this very tight range. You get this little fake out or V stop, breach back inside the level, pull back. You get our London flush setup back inside the level, and then boom, it's off to the races. This is a very good entry to take. You could take an entry here, stop loss at that low, or you could wait for the break of structure, wait for that pullback. 9 times out of 10, it pulls back. Have your low there if you want to be risky, or put it back there if you want to be conservative, and just let that puppy run, man. Same principles. Midpoint, take your extended target. But accumulation zones, they really tie up with the breaks of structure. Before the break of structure occurs, you will typically see an accumulation zone. So I think Chris and I, we've covered that in much depth in a prior video that we've done in the beginning of our YouTube channel. So we're not going to really cover it in much detail in this video. But yeah, man, it really ties in with the breaks of structure when you're looking for long setups. Distribution zones, which I should have put there, which I should have put that in there as well, are typically at the high points of markets. So we will look at that actually on the euro yen after this is done. And last but not least, your final step, fundamental and sentiment analysis. Chris and I were just going to say this right off the bat. We are not expert fundamentalists. We are technicians first, fundamental analysts second. Fundamentals are very, very important in the foreign exchange market, but the reason Chris and I aren't so focused on them is because no matter who you are as a retail trader, you will never have access to this high cutting edge information that these smart money hedge funds have. You don't have the software, you don't have the money, you don't have access to all of the stuff that is going to help you make some very, very good decisions. But sure, another issue that we see with fundamental analysis is that every retail trader is looking at the same shit. It doesn't help you. Now, it's important to have. Chris and I, we focus on macro fundamentals. We don't focus on like the short-term shit, man, such as like, I guess you could say, forex factory and things like that. We focus more on macro trends, macro fundamentals, business cycles, short-term debt cycles, long-term debt cycles, how certain currency pairs or assets are affected in certain market conditions, and that helps us make up the foundations of our decisions and our method. But yeah, we don't focus on like the short-term fundamental stuff, like the forex factory stuff. The only reason Chris and I would ever look at forex factory is to see what pairs are going to be volatile for that week.
Exactly. That's the only reason I use it for. I'm like the worst when it comes to fundamentals, Dave. I'm shit.
Bro, everybody is, man. And there's no problem in saying that. I'm not the best at it. Why? Because fundamentals are so manipulated, bro.
Yeah, it's so tough to
Sometimes
understand.
you get horrible news on a specific pair, like for example, the dollar, and it fucking goes full blown bull. Or sometimes you'll get bad news, good news, and the market completely tanks. So you never want to try to time the fundamentals, man. It's just Chris and I, we always wait for certain news releases to come out before we make a decision. Chris and I, we will never try to anticipate any form of news flows because we don't need it. We don't need it. If that's what you do, if you're good at trading that kind of stuff, by all means, man, let this be part of the process. But for us, we just focus on macro fundamentals, things like that, safe haven assets, risk on currency pairs, risk off currency pairs, how certain assets and currencies are affected through certain market conditions and things like that. That is what we primarily focus on. Macro trends and things like that. That's what keeps us consistent, and we will never try to be the next Ray Dalio or Warren Buffett. We just do things to the best of our ability. But yeah, fundamentals are just that extra edge that you can add to your method if you're good at it. If you're not, don't focus on it. The technicals will suffice. Mind you, us as specialists in technical analysis, we just look for footprints, man. We have a checklist that makes us money. This is why we have edge. This is why you have a process, is to keep you from making stupid decisions as a retail trader. So with that said, let me just go ahead and clean this up. That pretty much concludes the training, guys. We really, really hope that you found this valuable and insightful and that you guys walked away with some gems. and are ready to crush the markets this year and are just feeling a lot more motivated to know that this is a possibility. Mind you, that checklist, even though we were able to break things down, hopefully in a simplistic manner, it's taken us years to get to this point. So I know we've already been rambling on for about an hour or so, but before we close the video, Chris and I, we always just want to give you a treat since it's the fresh start of a week, and we want to give you guys something to work with so you can make some money throughout the week. So we spotted a short-term opportunity on the euro yen, and we are going to apply our principles on the euro yen.
Sorry to interrupt you, Dave. Since we're talking money now, did you exit that Aussie yen? Just hit our take profit. I have to tell you now, Dave, because I'm not sure, you know?
Give me 1 second, guys.
Yes, sir. Since we're talking money now, Dave.
Yeah, now let's talk money. Let's see. We took a short on the Aussie yen earlier, if you peeps are wondering what we're talking about. Yes, sir. Targets hit.
Now check out the CAD yen. It just hit that demand level that we were looking for, Dave. I entered, getting a nice little 1 to 2.78. Just want you to check it out since you brought the idea up to me, and it looks like it looks good.
Give me 1 second, bro. Yeah,
Take
targets
your
were
time,
made, guys. I'm just going to take a quick snapshot of the profits. And then we're going to post that on the Discord. So, dude, just real time, bro. This couldn't have happened at a better time. Hold on, give me a second. Let me post this shit on our Discord. We will pull that up just so you guys see that we put our money where our mouth is. Exciting times, man. Exciting times. Just 1 second, peeps. Sending it out to the Discord now. Take a snapshot. Yeah, so we, as we were just discussing, Chris and I, we took a short trade on the Aussie yen. It looked really good. If we have time, we'll walk through the criteria on that one as well. But the euro yen is going to suffice for the night. But yeah, man, that was a good trade. Targets made. Just posted the profits on our Discord. Nice little check for the day, man. We're starting the week off right. Euro USD from our last video, I was still holding that. So we're getting some pushback on that puppy. But fuck it, man. I'll be stopped out real soon. So we'll see what happens. But as of right now, good day so far. And we will see and keep you guys updated in real time if we come up with anything good. But anyways, so euro yen, we spotted a short opportunity. Let's go ahead and spot our criteria and see why this is practical stuff that we're teaching you. So first and foremost, once again, the markets are extremely dynamic. It's never going to look one way or the other. You just kind of have to roll with the punches and go with the flow of things. So as we've discussed prior, make sure your key levels are deployed. We got a key level at the 126. That looks good. Deploy your levels at the areas that are most relevant to you. 125 also looks good. So anyways, we got our break of structure here. Once this high was put in, you got another high that was put in, and then you got immediate failure at that high. Jesus, man, this is going to give me a problem. So now, this doesn't necessarily signal short immediately. Now we're just looking for other clues. So this right here, 1 second. Yeah, this is giving me a real hard time, guys. I think my internet's just acting up again. I had somebody fix it earlier too. I don't know what the hell the deal is. Anyways, this right here would count as a directional impulse move. When sellers or when traders see this happening in real time, they're getting enticed to chase this move. You get that nice little pullback. Extend that out to the left. You got this nice low put in. Extend that out to the right. Excuse me, I know I said left earlier. Boom. 1, 2. This little wick right here, that's a stop hunt, guys. Any trader, retracement trader that got in at that pullback, we know where their stop orders are. It's a little baby stop hunt right there. Boom. Price came back. Cleaned out these guys. So now, here we go. Another directional impulse move. Break of structure. Now we wait. We wait for a clean short setup. Got your little range right there. 1. Yeah, let me circle this. 1, 2, 1, 2. Are you guys starting to see how dynamic you have to be? It's not going to be this black and white approach. It's not cookie cutter stuff, man. So, and we got this high. We know there's liquidity up there. We also know there's liquidity up here. What Chris and I would like to see is that if price comes back, it can clean out that high or this high. We will look if we can see a trap here. If price comes back to this level, it's starting to sell off around that level, creates enticing price action for sellers to go short. Comes back, cleans that level, pulls back, retest that level at the 126. That would be an interesting level to transact. We'll definitely look to take that to the short side. Or it may not even do that. It could. This is another possible scenario. You have to anticipate as many scenarios as possible. There was a minor level around the 125, 500 or 50. Right there. Price could tank, hover around this level, stop hunt, and then boom, move.
Yeah, and I just like look at the level. It's at a 126, Dave.
Yeah, man. So it right now it's in perfect prime territory for us to be hyper focused to look for an opportunity. Anywhere above the 126 is going to be fair game for us to want to short. Or if it breaches, if it doesn't even pull back up there, it could just hover around the 125.50. Anything above that would be fair game to short. If you get stopped out on this initial trade, guess what? Price might probably come back and then create that setup, and then you'll look to act. May not get this on the first go, so Chris and I were going to be hyper focused. Where would you likely target? So now we know what to look for. We have our setups. Well, where is the bulk of liquidity? It's going to be right here at these lows. We know buyers are still profitable holding this trade because this level or this structure right here has yet to be invalidated. Also, we know there's profitable traders here. Buyers are still holding their trades long. This level has yet to be invalidated. Let's go ahead and deploy a trend line. Let's see if we can spot a nice trending structure. We like to use tools against the retail traders because it just makes our process a lot easier. I've already spotted something. Take a look at this. Go ahead and kind of clean that up just a bit. And trend lines are also confirmed the same way we confirm a level. The more tests, the better, but 1 to 2 tests will suffice. We got 1, 2, it's important to us. So we know retail traders are going to be making decisions. This is a dynamic stop hunt right here. This is a trap. No follow through, little stop hunt, boom. So we know, once again, that buyers are still profitable around these levels. Oh, dude, look at that. Boom, nice little break of that trend line. So we know sellers are going to be attracted to take the short. So it might, once again, just hover around this trend line. Any type of price action that unfolds around this trend line is going to be a good opportunity for us to take a short. And you're going to generally want to target the, if there is a price, if price does breach above the 126, you can target the 125.50 as the midpoint, and then your second target right at the 125. If you want to be a little bit ballsy, you can look to target slightly outside of those prior lows that were put in, because price always seeks out liquidity. So if there's liquidity there that we can say with confidence buyers are still holding, it's probably going to be invalidated, and you can look to run it slightly further outside of that level. So that's it, peeps. We will wait to see if this unfolds. If you don't get any trades, don't force it. Just let it be and just roll with the punches at that point. But that is pretty much it. You just saw our principles applied in real time. We know what to look for. And just for kicks, we're also going to show you the money that we just made for today on the Aussie short that we took. We're going to scroll back to when we took that, when I actually signaled to our guys, yo, Aussie yen is looking like a good short. And then you're going to see the results of that. So I'm going to go ahead and give Chris host. Give me 1 second. Clean that up. Stop share. Take over, my man. Once again, peeps, this is never financial advice. Always do your own due diligence. Understand any and all of the risks associated when trading any leverage products or the foreign exchange market. And if you love our content, do us the favor of hitting that like button, that subscribe button, and that notification bell button if you want to stay up to date with any of the content that we post. We always appreciate your love, man. Leave us some feedback, some comments, even if it's just an emoji, just like anything, a thumbs up. We always appreciate that. We definitely, if you found value in this, maybe some other guy is going to find value in it as well. So share this stuff with any of your trading buddies if you feel it's valuable, and just show us some love, man. And we love you all. So I don't know if you want to pull up our Discord, Chris, and then we'll walk through what has unfolded throughout the week, even though it's still early. It's still a Monday. But this is us just going through us having a conversation. There we are. There, you guys can see me right there. Aussie yen short, y'all's New York dump right on schedule. Still holding my trades from last week. Sundays and Mondays are trapped. So despite the pushback, I figured I didn't see a dump. I'd liquidate my positions, but so far so good. So anyways, immediately, I didn't even need to post a chart to just know that the Aussie yen was a good trade. But I'm pretty sure I posted a chart somewhere in there.
Yeah, I think this was an idea that we've been kind of going on, Dave. I think like since the end of last week.
Yeah, it was towards the end of last week. I know I posted a chart somewhere about it. Oh, don't show that. we dick around here as well, guys. Just so you know, we try to keep. This is so weird. I know I posted a chart about it.
The only one that you've posted, Dave, this today has been that I think that Euro yen. That's it.
I think that was a CAD yen. That's strange. By the way, the important thing is that we did discuss it, that we did say we were going to take a short on it, and
so I made a pretty $500, about 544.
Not bad for a Monday, man. Not bad for a Monday. The beautiful thing about being a trader, guys, is that your payday is every day, man. If you make money every day, your
every
payday.
day is the first. Yes,
Hell yeah, man. So this is literally the picture that I just posted on the video, and we made about a cool almost $1,500 for the day. Not a bad way to start the week. Could be more, could be less by the end of the week. Who knows? But if that Euro yen plays out to our anticipations, we're going to have a good week, man. And we've been consistently profitable week in and week out. We've had a red week here and there, but generally we're fairly consistent. So we can't make this stuff up. We're showing it to you in real time, in your face. Not to brag or to boast, but to show you guys that it is a possibility if you want to become traders, because we know there's a lot of smoke and mirrors, a lot of bullshit out there in the industry. Chris and I, we're trying to step in and just clean this shit up, man, because it is a damn shame what's going on in the industry. This is a very ruthless and difficult profession as it is, and the last thing we need is a lot of misinformation that is causing a lot of traders to get hurt, man. And there's some sad stories out there, bro. Like, people, it doesn't get talked about a lot, but people really put themselves in some horrible financial positions in this due to trading and investing, and sometimes it results to them, taking their own lives because they're in such a bad spot. So I don't think I need to bang about the recent story about that 21-year-old kid taking his life due to some like Robinhood trade or whatever. It's the reality. I don't know the full deets and dats of that, so I'm not going to bang about it like I know. But what I will say is that this is a reality. People go through some tough times. So trade safe, man. Stop trying to get rich. Stop trying to take that lottery trade. Stop trying to get rich overnight. Just be consistent. I would much rather you guys make a lot of money in a consistent fashion than a lot of money in one clean swing. Evolve as a trader. Focus on the long haul. And you just have to win, man. The whole point of being a successful investor and trader is to stay in the goddamn game. You can't win if you can't stay in the game. So stay in the game. And you can't stay in the game if you're like freaking over leveraging on every trade. You're risking 50% of your goddamn account on every trade. So that's pretty much all I have to add, man. Do you got anything to add on that, Chris?
Nothing much, sir. Let's make this money.
Yeah. So there you have it, peace. We really hope that you found this training video invaluable. It would mean the world to us if once again you could just hit that like button, subscribe button, notification bell button. Leave us some comment if there's anything specific that you want us to cover, anything that you want us to see, and let us know if you're making money with our content. That's what Chris and I really want to know. Mind you, we have no ulterior motives. We want all of you winning, and we hope that you guys are starting to get more stimulated and motivated to focus and sharpen your craft, because this is a possibility. This can happen literally. To this day, I still can't believe where I'm at in the grand scheme of things, and I still got a long way to go, man. I'm baffled of how much I still don't know in the financial markets, but once you have your method, the rest follows. But
Yes, sir. If there's something I could add, Dave, the only thing is that something I can recommend is just to back test all these things we went through, because what you want to do is you want to familiarize yourself and your eye to all these things, and that's the reason why we make it look so simple when we just pull up a chart and just do like I just marked everything down pretty much in less than 2 or 3 minutes. We make it look easy, but it takes a while for you to train your eye to do it. So what I would recommend is literally pull up any chart and just go back and see if you can check out as much criteria of a trade and see it work out. Continue doing that, and eventually it just becomes second nature, and it's gonna happen immediately when you see a chart. You know if you should even be looking at a chart or not.
I love it, man. Love
Yep.
the way you close that, bro. No better way to close that. So there you have it, peeps. Take Chris's word on it, because yeah, back testing is very important. Go back on old charts, map this stuff out. Just pay attention to how certain structures form, and just try to make sense of this stuff. And once you have a collection, I literally snapshot my best trade setups. I take pictures of them. I draw on my charts, and I just save the ones that work out best, because I'm training my brain to know what my A1 setups look like. So
Look at this right here, Dave. We see it back and just nonstop. You get an impulsive move. You have a break of structure. You
at
have
the
a
lows,
at the lows, and then you have a range right here. You have a nice little trap right here. Boom. The man gets hit. You got two take profits. That's first at the trap, one at the top of the range, and boom, it just continues. And you
that's
just that's it.
That's it, man. Love that. And I love how you kind of went back and illustrated that example there. You have a long play on that one, man. So, God, that was a mouthful. I'm a little bit drained, but I love doing this nonetheless. Mind you, guys, this isn't even work for Chris and I. We just love doing this so much. So all we can say is just stay safe, trade smart, trade well. Most importantly, have fun with this stuff and just take your time with it. Everybody's journey is going to be different. Don't compare yourself to anybody, not to me, not to Chris, not to some hot shot that you see on Instagram or whatever. Take your time with it. Focus on your own individual process. And if you're true in nature and purpose, your intentions are in the right place, it will come to you no matter what. But it's not going to come overnight. I'm sorry to burst your little bubble. This is a craft and a skill like anything else, man. It's going to take a lot of time and dedication and commitment on your end. But once you've put in that time, trading is so beautiful in the respect that despite it being difficult, your level of your income potential is not capped. Your income potential is limitless in this business, but it will only increase as your level of skill and experience increases. So yeah, man, that's why Chris and I were gonna die doing this stuff, and we're gonna see where we end up in the next couple years. Because in the time that we have, we still feel like we don't know much, but we're
Every day I
making money.
wake up, Dave.
Yeah, we're doing all right though. We're doing all right for ourselves, and we're just gonna keep pushing and pushing up until we see where our journey takes us. And if we can get as many of you up here with us, that's the best gift that I can give to the trading community and to myself before I leave this earth. It's all I ever wanted to do, man, is just to leave my mark big or small before I die. Because what else do we have? What other purpose do we have than to leave this world slightly less shittier than we found it? If I think you can stick to that, man, you got good things coming. So
Yep.
that's all we have to say. We love all of you. Stay safe, and we'll catch you sometime this week, man.